This is the world's GDP. Everything the planet produces in 1 year. $90 trillion. And this is the world's debt. $300 trillion. Stop for a second. The debt is over 3 times the total wealth of the world. More than everything that exists, that's produced, that has value. How is that possible? And more importantly, who did the world borrow from? If everyone owes money to someone, who is that someone? Follow me, because the answer will make you reconsider everything you thought you knew about economics. To understand this, we need to go back, way back. Debt isn't a modern invention. It's one of the oldest ideas in human civilization. It emerges when someone understands something incredibly simple. Sometimes you need something now, but you can only return it later. Spring. You need grain to plant. Your neighbor lends you a sack. After harvest, you return too. No bank, no written contract, just trust. Let's keep that word in mind. Trust. Because it's the word that holds the entire global economy together. Then come the kings, the empires, the wars. And debt stops being an agreement between neighbors. It becomes a tool of power. England under Charles II is on the verge of bankruptcy. He needs to prepare for war against the Dutch. Nobles won't lend money. The state coffers are empty. What do you do when nobody wants to give you money? Simple. You take it from everyone. The government bond is born. In exchange for immediate cash, the government promises to repay everything with interest. Not to a specific person. To whoever buys that piece of paper. Bond. The word literally means connection, obligation, pact. That's when states discover they can finance enormous expenses without raising taxes. And those bonds are used mainly for one thing: destruction. For centuries, debt serves to wage wars. Not to build, to destroy. The real change comes in the 20th century. World War II is over. Europe is in ruins. Japan is devastated. States have accumulated debt like never before in history. Astronomical figures. Unthinkable. But then something new happens. They use the same mechanism to rebuild. Roads, houses, industries, hospitals, schools. Everything financed by borrowing. For the first time in history, debt becomes a tool of development. Not just war anymore. And here enters the system that still governs the world today. 1944. Bretton Woods. The United States emerges as the global economic superpower. A system is created where all world currencies are tied to the dollar. And the dollar is tied to gold. Every printed dollar must have an equivalent in gold in American vaults. It's a physical guarantee. A break. You can't create money at will. You need the gold to back it. But there's a problem. Economies grow. Trade increases. States spend more and more. 1960s. The United States accumulates gigantic deficits. Vietnam War. Domestic social programs. Spending upon spending. They need more dollars. Many more dollars. But in the Fort Knox vaults, the gold remains the same. The world fills with dollars that no longer have backing. August 15, 1971. President Richard Nixon makes a decision that changes everything. He suspends the convertibility of the dollar into gold. From that day, the dollar is no longer a certificate guaranteeing a quantity of precious metal. It's a piece of paper whose value depends exclusively on one thing: trust in American institutions. End of the gold standard. Beginning of fiat money. Money created by decree. From that moment, the limit on how much money you can create becomes essentially political. And if you can create more money, you can take on more debt. The global system enters a new era. It's no longer about how much gold you have. It's about how much trust you can generate. Money is worth something because the state says it's worth something. And because people trust, it will continue to be worth something. This is crucial. Both money and debt only work if there's trust. A banknote is valuable because tomorrow someone will accept it. A government bond is valuable because we believe the government will repay it. When this trust falters, the system collapses in days. Greece 2010. Argentina multiple times. Weimar in the 20s. Not because the money runs out, because credibility runs out. But how does this mechanism actually work? Economist Ray Dalio explains it brilliantly. Credit is an agreement between two people who decide to create something from nothing. When you take a loan, a debt is created for you and credit for whoever lends to you. That promise of payment is new wealth entering the system. It's not taken from a vault. It emerges as a relationship between debtor and creditor. And this has an immediate effect. Credit allows you to spend more than you earn today. Your spending becomes someone else's income. More income means more creditworthiness. More creditworthiness means more credit. More credit means more spending. It's a self-reinforcing cycle. Credit creates spending. Spending creates income. Income creates new credit. This is where debt becomes the heart of the system. After the end of the gold standard, states discover they can use debt not just for emergencies. They can use it as a structural tool to keep the economy running. When they go into debt, they inject new spending into circulation. That spending reaches citizens. Citizens consume. Businesses hire. The economy grows. Future growth, in theory, serves to repay today's debt. In theory. Because in practice, increasingly often states borrow to repay interest on previous debt. And this is where things get complicated. We arrive at the initial question: who do we owe all this money to? When we hear that public debt is out of control, we imagine a great creditor, a foreign power, a bank controlling everything. But it doesn't work that way. Debt isn't a linear relationship. It's a circular system. Take the United States, the most indebted country in the world. $38 trillion of public debt. It's true that China and Japan hold a significant portion, but the majority is held by Americans themselves. How? Simple. You put money in a bank. The bank reinvests it. In what? In US government bonds. Because they're the safest possible investment. It's virtually impossible for a state to fail. The same goes for pension funds, for insurance companies, for institutional investors. A huge portion of American public debt is simply American savings in another form. And it doesn't end there. Countries buy bonds from other countries, not out of altruism, because they consider them reliable investments. Japanese savings end up in American bonds. American profits get reinvested in Europe. European banks buy Chinese bonds. It's a circuit. Money circulates, returns, reinvests itself. Nobody lends in a linear way. Everyone lends and everyone borrows. But there's an even more important and apparently absurd point. This debt will never be repaid. It's not supposed to happen. And above all, nobody wants it to happen. Public debt doesn't work like a house mortgage. It's not something to pay off eventually. It's a structural mechanism of the modern economy. A state continuously renews its debts. When a bond matures, it issues another, takes new loans to repay old ones. and keeps the cycle moving. If a government tomorrow decided to repay all its debt down to the last cent, it would be a disaster. It would have to withdraw a gigantic amount of money from markets, drain citizens' savings, cancel interest and returns, destroy one of the pillars on which pensions, funds, and insurance rest. The point is that the modern economy is built on the existence of debt. It's counterintuitive. We're used to thinking of debt as something to eliminate. Instead, it's what holds the economic machine together. But then, why do we sometimes hear about debt crises? About emergencies? About panic? When does this mechanism break down? Always the same answer: trust. Debt becomes a problem when trust breaks. Not when it increases. Not when it exceeds a certain threshold. The critical point is when the market stops believing a state will be able to honor its promises. As long as investors believe a country can go deeply into debt without creating panic. Japan today has a debt-to-GDP ratio of 230%. Italy is at 137%. Yet Japanese bonds are considered among the safest in the world. Ours are perceived as much riskier. It's not about absolute numbers. It's about credibility. The problem arises when debt stops financing productive investments and starts financing itself. This has been Italy's situation for years. Most new bond issues serve to refinance maturing bonds and pay interest on debt. It's not an anomaly in itself. Several countries do this. But it becomes a problem when economic growth doesn't keep pace. If GDP doesn't increase, the weight of interest remains constant or worsens. And the market starts asking, how long can this last? Not because the money is running out, because investors' patience is running out. What matters is sustainability. A state's ability to pay interest year after year without compromising essential services. And its economy's ability to grow enough to keep that debt manageable. Trust serves this purpose. To believe that tomorrow the country will be in the same condition or better than today. And it's a fragile balance. If investors start doubting even a little, the cost of debt rises. And when the cost rises too much, the spiral becomes dangerous. So, returning to the initial question, who did the world borrow from? The answer is simple and shocking at the same time. The world borrowed from itself. We're all debtors. And we're all creditors. Your bank savings are the state's debt. The state's debt is a pension fund's investment. The pension fund buys bonds from other states. And so on infinitely. It's a system that only works if it keeps spinning. If trust holds. Global debt isn't a problem to solve. It's the structure on which the modern economy rests. As long as there's trust, the system holds. When trust cracks, everything collapses. Not because the money runs out, because the belief that money has value runs out. And that belief, in the end, is the only thing that makes everything work. World debt is 3 times world GDP. Not because we borrowed too much, but because we created a system where borrowing is the only way to move forward. And as long as we believe it works, it actually works. The day we stop believing, that day we'll discover whether money is real or if it's always been just a shared illusion.